Given that physicians are usually seen as deep pockets by the non-physician world, and that the US seems to be getting more and more litigious every day, how can you protect your hard-earned assets from lawsuits and other legal actions? In today's video, I'll be interviewing Ekta Patel, Director of Financial Planning at Altfest Personal Wealth Management, who will tell us important techniques that you can use to better shield your assets from hungry plaintiffs so you can better protect your family's hard-earned assets and also your own peace of mind. Also, be sure to stay till the end of the video where Ekta Patel is going to talk about giving you an update on some important malpractice-related legislation and some steps that you can take to mitigate its effects. Hi everyone, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides investing and personal financial planning insights to help physicians achieve their key financial and life goals. Before I bring in Ekta, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while as a legal fiduciary, always putting physicians' best interests first. As physicians, you likely will want to know also that Altfest is the preferred wealth manager for members of the Medical Society of the State of New York and the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, just to name a few of the associations that we partner with. As I mentioned, we are very happy today to have here on the channel Ekta Patel. Ekta is a certified financial planner and an MBA and the Director of Personal Financial Planning at Altfest Personal Wealth Management. Ekta also sits on the firm's Investment Leadership Committee and has been with the firm for nearly 20 years. This is the first of two videos with Ekta Patel on ways to shield your hard-earned assets from legal actions. Before we go into asset protection / shielding your hard-earned assets from legal action, we need to say that the information provided today is for educational purposes only and should not be taken as advice for any physician's specific situation. Also, we're not lawyers and so we're not giving any legal advice. As comprehensive wealth managers, however, we are able to identify potential issues in many areas of a physician's financial life, and we also work with the physician's other key professionals, such as accountants and attorneys, to make sure all financial areas are fully optimized. Ekta, thank you very much for joining us today on Wealth Matters for Physicians.
Well, thank you for having me.
Let's go right into it. First, let's talk about risk management. So first, Ekta, let's talk about risk management. Regarding malpractice insurance, how much does a physician really need? I know it's a difficult question.
Well, it's a good question, and we usually help our clients, physician clients, help figure this out. The answer, it depends. It depends on a number of variables that affects your practice. A good starting point, in my opinion, is to start with, what are you trying to cover? Just make sure you have enough coverage for damages, for instance, for lawyers' fee, the defense cost, and also the final judgment. I understand it's hard to sort of predict what that might be, but it's a good starting point. Look, malpractice insurance is a foundational insurance for your practice. It is also likely to be an expensive insurance, so you want to be very thoughtful about how much you get. And it may help physicians to understand where they practice, to check, what their peers are carrying in their particular geographic area. Is your specialty more prone to lawsuits? I think that's one of the questions you could ask yourself and ask your peers, how often, the lawsuits come up in the area they practice, in the geographic area that they practice. So these are good starting points for physicians to think about, to understand how much they need. And also part of it is your own risk preferences, how much you're willing to keep it on your own balance sheet and how much you're willing to delegate to an insurance company and what that would cost. So these are the factors we work with physicians. We help them understand to figure out how much insurance they should carry.
Thank you very much. And I know in malpractice insurance, the subject of tail insurance comes up. Can you explain what tail insurance is briefly and why it's important?
Sure. In our work with physicians, we often find that tail insurance is an overlooked area, so watch out for tail insurance. It's an insurance which covers you for a specific period of time. And most physicians think that they are covered through their previous employer's policy if a claim opens up after they've left their previous employer. So really it's an insurance that if you transition to a new job and the claims open up at your previous workplace, this insurance helps you with that cover that particular claim. So it's extremely important to have that. For example, we know of a physician who was in transition to a new place and did have a tail coverage about $50,000. However, when he left and started at a new place, a claim was opened up. And making long story short, he ended up paying $100,000 out of pocket for lawyers' fees and other defense costs and here's the kicker, for a lawsuit that he ended up winning.
Right, he won,
but he was still out of pocket for that. So while it's a minor thing and people may not think a lot about it, it's important to understand that they have a proper tail coverage.
Right. And also, another type of insurance you've mentioned in the past is important to have, and that's umbrella liability insurance.
Yes.
So what does that cover?
Now, if there's one thing people can do for their asset protection is make sure they have enough umbrella coverage. So what is umbrella coverage? It's a coverage that protects you from your personal liabilities that come up, non-malpractice related liabilities. And the way it works is that it comes with either your auto or home insurance policy. So you have your auto policy, home insurance policies, and sits right on the top as an umbrella, like the name suggests, on those policies. And it covers few things. It covers bodily injuries. It covers injuries to damage to a person. It covers damage to a property like a car or a home. Policies nowadays also cover libel, slander, defamation, etc., which has become some sort of a norm these days. And if our physicians are in the business of being a landlord, if they have several investment properties and so on and so forth, and if they have these liability coverages on those properties, then they will cover the items arising from those property as well. So it's an extremely important insurance to have in your risk management strategy. As a risk management strategy, I also feel that it's a relatively inexpensive insurance to have, unlike malpractice insurance, because for a couple of $100 you can buy an extra $1 million in policy. So it's important to understand that it does give you a protection for a very small price. So if there's one thing people can do with the asset protection is make sure they have enough umbrella coverage, especially if they are at a risk, in the sense that if they have a pool in the house, right, somebody can slip and fall, or if they have a teenager driving a car, right, these are easier things that can happen and you can't really plan them. And insurance, in a way, is really not going to prevent any lawsuits for you, right? It's only going to provide you with resources,
right? Protection.
So it's important to have an optimum insurance planning, especially for physicians.
Great. And I know, again, there's no one-size-fits-all answer to this, but how much umbrella liability insurance should one have? Is there like a general rule?
So this one is a little bit easier than figuring out malpractice insurance, in my opinion.
That's
It
good.
still depends. But for us, a rule of thumb is look at your current assets. Look what you own. Look what your net worth is. Basically, take out your liabilities. You own a home, you have investment assets, etc. Just add them up. You have some collectibles, for instance, and see what you're worth. So that's a starting point. With physicians, they are considered deep-pocketed people. So in an event of lawsuits, there are chances that people may come after their future earnings, right? If they are making a lot of money. So their future earnings can be garnished as well. So do take that into account, several years of future earnings, if you can, to the extent you can, and if it's not too expensive for you to carry. And like I said, this is inexpensive form of insurance in the realm of insurances. So I would say start with that, and that could give you a pretty good coverage. And as your situation changes, please do evaluate it. As your net worth grows, consider getting higher coverages.
And that's one of the things that Altfest does for its clients, right? Is sees how much as their assets grow, see if it's time to add more coverage or maybe reduce coverage over time. It's a balancing act.
Certainly, yes, absolutely. So if a physician is in their accumulation phase, the assets are growing. So we regularly, look at that and make recommendations accordingly. But then in your retirement, when you're in a deaccumulation phase, maybe there's no need for, garnishing future earnings because there are none. So then, we would reevaluate to see if it continues to make sense.
Great. So Ekta, let's now talk about ERISA-related workplace retirement plans versus non-ERISA-related retirement accounts. First of all, why is this an important distinction? And can you give us some examples of like an ERISA-related plan or plans?
Sure. So let's talk about it from a perspective of asset protection, right? This is a legislation that was passed in 1974, and what it does is it allows a different level of protection that's provided to employer-sponsored plans or individual retirement accounts.
Right.
And both federal government and the state government provide certain level of exemption from creditors. So in the event if there are creditors coming after you for lawsuits, then these type of assets enjoy protection. They cannot pierce into ERISA and non-ERISA plans. So that is really the difference. Now, the ERISA plan is an employer-sponsored plan, like 401k, 403bs, 457 accounts, etc. And the non-ERISA plans are your individual retirement accounts, whether they're traditional contributory IRAs, Roth IRAs, even individual 401ks. They are non-ERISA plans. ERISA plans, the assets in those type of plans, ERISA plans, are protected. They receive unlimited protection under federal law.
Unlimited. That's great.
Yeah. And the ones in non-ERISA plans, the IRAs, they receive some exemption as well, but that protection varies drastically from one state to the other. Some states provide 100% protection to the assets in your IRAs, whereas the others, some protection against creditors.
Great. Ekta, thank you very much. That's very helpful. Now that we know the importance of ERISA protection versus non-ERISA protected plans, can you give our physician audience any strategies that can harness some of the benefits of ERISA?
Oh, yeah, certainly. And we often use strategies to help our clients take advantage of these exemptions. Look, you can start with maximizing your annual contributions to your employer-sponsored plans, ERISA plans, first.
Excellent.
Because they receive, like I said, unlimited protection against creditors under federal law. So start with that. Then, if your income level allows, you can consider maximizing your non-ERISA accounts, like your IRAs.
Right.
Now, within that, depending on how you fall on the tax bracket spectrum, if you're in a lower tax bracket or medium tax bracket, and if you have Roth, which are post-tax accounts available to you, whether it's a Roth 401k or a Roth IRA, consider contributing to those first. And the reason why I say that is that once you turn 72, you're required by the IRS to take a mandatory distribution from your traditional IRAs or traditional 401ks.
Right.
So these are pre-tax amounts. At 72, you should start taking the money out, and that becomes a taxable income.
Right.
As against in Roth accounts, because you pay taxes today, you are not required to take the distributions at the age of 72. And when you're not required to withdraw the assets, they are not accessible to your creditors. So in that sense, trying to prioritize Roth in conjunction with your tax situation could be a better asset protection strategy as well.
Thank you.
And finally, I'll leave you with one more, which is my personal favorite, Roth conversions. If you don't have access to Roth accounts so far, there you have an ability to convert your pre-tax account into post-tax account. Now, how does this work with the asset protection? So let's say you have $500,000 in your traditional IRA, and you move that assets, all of it, into a post-tax account, Roth IRA.
Right.
That will trigger an immediate tax bill.
Right.
The IRS requires you to pay a tax bill. So on that $500,000, let's say you have taxes that you owe of $100,000. So you should have, those cash set aside before you make this decision.
Right.
Also, I would caution that, work with your financial advisors and CPA to make sure that strategy is right for you at that time. That in the event if you're able to do so, you're essentially moving pre-tax to post-tax. And like I just mentioned, it receives protection because you don't have to take required minimum distribution,
Right.
and the withdrawal is not accessible to the creditors. But at the same time, the $100,000 in taxes you pay, that money is sitting in your bank account in cash. That asset is not protected. It doesn't receive exemptions like your IRAs do or your 401ks. So you're essentially moving that asset, unprotected assets, to help pay for the taxes, put the money in Roth, and over a longer period of time, you more than make up for the taxes you pay and get some asset protection as well.
Excellent.
So that's my favorite strategy.
Thank you very much. I think our physicians really like that. This is the end of the first part of our interview with Ekta Patel on ways to shield your hard-earned assets from legal actions. Please join us for the conclusion of our interview with Ekta Patel in our next video. If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investing portfolio or retirement readiness, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video about providing insights to help physicians optimize their personal finances and achieve financial independence, please click the subscribe button and hit the bell icon below to receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please feel free to share it with him or her to help them get their finances optimized too. Lastly, as always, this channel is for you. We want to make this as interesting and as useful and as enjoyable as possible. If you have any topics you'd like us to cover, have any questions for us, or dislike certain things that we're doing, we want to hear it. So please give this and any other feedback in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and remember to keep on optimizing your finances, or ask us for help if you'd like.